Imagine two people. Both are 30 years old. Both have exactly $100,000. Both want to build wealth. Both invest in 2026. One buys property, the other buys a broad stock market index fund. Fast forward 30 years, one ends up with millions. The other also ends up with millions, but they get there in completely different ways. One used leverage, the other used compounding. One dealt with tenants, the other dealt with market volatility. One owned buildings, the other owned businesses. And that's why the debate between real estate and stocks never seems to end, because both sides can point to real success stories. Today, we're going to compare them using the same assumptions, the same starting capital, the same timeline, and the same mathematics, not to decide which one is better, but to understand how each one actually works. Because in 2026, understanding the difference may be more valuable than choosing a side. At first glance, both assets appear to do the same thing. They help people build wealth, but under the surface, they operate very differently. When you buy stocks, you're buying ownership in businesses. When you buy real estate, you're buying ownership in property. That sounds simple, but the way returns are generated is completely different. Stocks grow primarily through business growth, corporate profits, dividends, compounding. Real estate grows through property appreciation, rental income, mortgage paydown, leverage, same goal, different engines, and understanding those engines is where the real education begins. Let's start with something practical. Imagine you have $10,000 today. Can you begin investing in stocks? Yes. Many index funds allow investors to start with a few $100s, sometimes even less. Now imagine using that same $10,000 to buy investment property. In many major cities around the world in 2026, that won't be enough for a down payment. This is one of the biggest structural differences between the two assets. Stocks allow participation with relatively small amounts of capital. Real estate often requires substantially larger upfront commitments. Neither is better. It's simply a different entry requirement. Many people imagine stock investing as buying and selling. In reality, most long-term investors are participating in something much simpler: business growth. Imagine investing $100,000 into a broad market index fund. Historically, large diversified equity markets have produced average annual returns around 8% to 10% over very long periods. Not every year. Some years are terrible, some years are exceptional, but over decades, that's roughly the range many investors reference. Now let's assume 10% annual growth. After 10 years, $259,000. After 20 years, $673,000. After 30 years, approximately $1.74 million. Notice something: the final decade creates more wealth than the first decade. That's compounding. Growth creating more growth, which then creates even more growth. Now let's look at property. Suppose someone purchases a $500,000 property. They put down $100,000 and finance the rest. This is where real estate becomes interesting, because unlike stocks, investors often control large assets using borrowed money. This is called leverage. Imagine the property appreciates by 10%. The property is now worth $550,000. That's a gain of $50,000. Yet the investor initially contributed $100,000, which means the gain represents a 50% return on the original cash invested. This is one reason property investors often achieve significant wealth. Not because houses necessarily grow faster than businesses, but because leverage amplifies outcomes. But here's what many discussions leave out: leverage amplifies losses too. Let's use the same property. Value $500,000. Now imagine prices decline 10%. The property is worth $450,000. The decline is $50,000. Again, half of the original cash investment. The same mechanism that accelerates gains can accelerate losses. Leverage isn't good. Leverage isn't bad. It's simply powerful. And power works in both directions. Let's compare ownership. Imagine an investor owns $1 million worth of index funds. Maintenance cost? Essentially zero. No repairs, no tenants, no plumbing emergencies, no roof replacement. Now imagine an investor owns $1 million worth of rental property. There may be maintenance costs, property taxes, insurance, vacancies, repairs, management fees, unexpected expenses. Real estate often produces more involvement. Stocks often produce more simplicity. This difference rarely appears in return calculations, but it affects the investor experience significantly. Now, what makes 2026 different? Every decade creates a different investing environment, and 2026 is no exception. Property markets in many regions remain substantially more expensive than they were a decade ago. Financing costs are higher than the ultra-low interest rate environment investors became accustomed to in the past. At the same time, low-cost index investing has become more accessible than ever. This creates an interesting contrast. Historically, many property investors benefited from both appreciation and declining borrowing costs. In 2026, investors are often evaluating properties under a different set of assumptions. Again, this doesn't make one asset superior. It simply changes the mathematics, and investing is ultimately a mathematical exercise. Let's talk about the $1 million experiment. We'll run a simplified comparison. Investor A places $100,000 into a diversified index fund. Investor B places $100,000 into property equity. Assume 30 years. Stock return, 10% real estate total return, 7% after 30 years. Stocks, approximately $1.74 million. Real estate, approximately $760,000. At first glance, stocks appear to dominate. But remember, this comparison excludes leverage. Now assume leverage significantly boosts real estate returns. Suddenly, the outcome changes. This is why investors often arrive at completely different conclusions. They're not using the same assumptions. Many people describe stocks as risky, others describe property as risky, but risk means different things. Stock investors often experience volatility. Prices move daily. Real estate investors often experience concentration. Large amounts of capital tied to fewer assets. One asset may feel emotionally uncomfortable. The other may create operational challenges, different risks, different experiences, same objective. After decades of debate, one interesting conclusion appears again and again. Most successful investors aren't successful because they discovered a secret asset. They're successful because they understood the asset they chose. They understood how returns are generated, how risks appear, how time affects outcomes, how compounding works, how leverage works. The asset matters, but understanding the asset matters even more. Real estate and stocks have both created enormous wealth throughout modern history. Neither is a shortcut, neither is guaranteed, and neither tells the whole story on its own. Stocks offer a fascinating demonstration of long-term compounding. Real estate offers a fascinating demonstration of leverage and cash flow. Different mechanisms, different experiences, different trade-offs. But perhaps the most important lesson is this. The debate becomes much less confusing once you stop asking which asset is superior and start asking how each asset creates its returns. Because wealth is often built not by choosing sides, but by understanding the mathematics behind the choices. I'm Morgan Vals. Build small, grow strong, live free, and I'll see you in the next video.